Imagine waking up on the first day of every month and seeing $1,000 deposited into your account, without clocking in for work, without chasing overtime, and without trading your time for money. For millions of Americans, passive income isn't just a dream. It's becoming a financial survival strategy. Rising living costs, unpredictable job markets, and inflation are forcing people to rethink how income works. But here's where most people get it completely wrong. They assume passive income is built through shortcuts, risky bets, or viral investing trends. The truth is far less exciting, but far more powerful. Passive income is built through math, patience, and strategy. And today, we're breaking down the exact numbers behind earning $1,000 per month in passive income. Not guesswork, not motivational hype, but realistic investment calculations based on how the US market has historically generated income for long-term investors. Before we talk about how much money you need invested, you need to understand one critical concept that most beginners ignore. Passive income depends entirely on yield and return strategy. Not all investments generate income the same way. Some investments focus on dividends, where companies share profits with investors. Others focus on interest payments through bonds or fixed income funds. And some rely on total return strategies, where investors withdraw a portion of long-term growth gains. Each approach changes how much money you need invested to reach $1,000 per month. So instead of throwing random numbers around, let's break this down using realistic yield ranges that reflect how US investors typically generate passive income through ETFs, dividend stocks, and income-focused portfolios. Let's start with one of the most conservative and commonly used passive income strategies: low-risk income investments generating roughly 3% annual yield. These might include high-quality bond ETFs, conservative dividend funds, or balanced income portfolios designed to prioritize stability over aggressive growth. If your investments generate around 3% annually, earning $12,000 per year, which equals $1,000 per month, would require approximately $400,000 invested. That number often surprises people because it feels large, but it reflects the trade-off between safety and income. Lower-risk investments tend to generate smaller yields because they focus on protecting capital and reducing volatility. Many retirees and conservative investors prefer this strategy because it provides predictable income with lower market fluctuation exposure. Now let's look at a slightly higher income strategy that many American investors pursue: moderate dividend and ETF portfolios generating around 4 to 5% annual yield. This range is commonly associated with diversified dividend ETFs, real estate investment trusts, and high-quality income-focused equity funds. At a 4% yield, you would need roughly $300,000 invested to generate $12,000 annually. At a 5% yield, that number drops to about $240,000. This is often considered a realistic middle ground approach, balancing income generation with long-term growth potential. However, higher yields usually come with increased market sensitivity, meaning investment values may fluctuate more during economic downturns or interest rate shifts. Then there's the strategy that attracts massive attention online: high-yield income portfolios generating 6 to 8% or higher. These may include specialized dividend ETFs, covered call income funds, high-yield bond ETFs, or alternative income strategies. At a 6% yield, earning $1,000 monthly would require approximately $200,000 invested. At 8% yield, that number drops closer to $150,000. While those numbers sound significantly more accessible, higher yield investments typically carry additional risks. High yields can fluctuate more, may depend on complex strategies, and sometimes reduce long-term capital appreciation. Investors chasing high yield without understanding underlying risks often experience income instability or declining portfolio value over time. Another factor that dramatically impacts how much you need invested is reinvestment strategy during the wealth-building phase. Many successful passive income investors don't start by withdrawing income immediately. Instead, they reinvest dividends and interest payments for years or even decades. This reinvestment accelerates compounding growth, which reduces the total investment required later to reach income targets. For example, an investor consistently reinvesting dividends within diversified diversified ETF portfolios historically experiences faster portfolio expansion compared to investors withdrawing income early. Compounding is often called the eighth wonder of the world for a reason. It transforms time into one of the most powerful wealth-building tools available to investors. There's also a major misunderstanding surrounding passive income timelines. Many beginners assume passive income must come from a single lump sum investment. In reality, most Americans build passive income gradually through consistent monthly investing, employer retirement contributions, and long-term portfolio growth. For example, contributing $500 to $1,000 per month into diversified ETFs over multiple decades, combined with historical average market returns, can realistically build portfolios capable of generating meaningful monthly passive income later in life. Time in the market historically beats timing the market, and consistent investing dramatically reduces the burden of needing large upfront capital. Another key piece of the passive income equation involves understanding total return versus income-only investing. Some investors focus entirely on high dividend or income-paying investments, but financial research often shows that combining growth ETFs with controlled withdrawal strategies can produce more sustainable long-term income. The widely discussed 4% withdrawal rule, often used in U.S. retirement planning, suggests that withdrawing roughly 4% of a diversified portfolio annually has historically allowed investors to maintain income without rapidly depleting principal. Under this model, reaching $1,000 per month passive income would require roughly $300,000 invested. However, this strategy relies heavily on market performance, diversification quality, and disciplined withdrawal management. Taxes also play a significant role in determining how much you need invested to reach passive income goals. Dividend income, interest payments, and capital gains withdrawals may be taxed differently depending on account type. U.S. investors using tax-advantaged accounts such as Roth ERAs, traditional IRAs, or 401k retirement plans often experience significantly different after-tax income results compared to taxable brokerage accounts. Smart passive income planning considers tax efficiency because taxes can quietly reduce income performance if not strategically managed. Another element many passive income calculators ignore is inflation adjustment. Earning $1,000 per month today may not provide the same purchasing power 10 or 20 years from now. Inflation historically reduces currency value over time, meaning passive income strategies should ideally include investments capable of growing alongside or outpacing inflation. Equity-based ETFs, dividend growth funds, and real estate income strategies are often used by investors seeking both income and inflation protection. Without growth-focused components, passive income streams risk losing real-world value even if payment amounts remain constant. And this is where passive income planning becomes more strategic, because the most successful U.S. investors don't just ask, "How much do I need invested?" They ask, what combination of growth, stability, and income will allow my portfolio to survive multiple economic cycles? Market history shows that economic recessions, interest rate changes, inflation spikes, and stock market volatility all influence passive income investments differently. Investors who rely entirely on one type of income strategy often face higher vulnerability during economic shifts. There's also an overlooked psychological factor tied to passive income goals. Many investors focus exclusively on reaching the $1,000 monthly income milestone, but long-term wealth builders often focus on building scalable income streams that grow over time. The difference between static income and growing income becomes significant over decades. Dividend growth ETFs, for example, focus on companies that consistently increase payouts, allowing passive income streams to expand gradually without requiring additional capital investment. This approach not only improves income sustainability, but also helps investors maintain purchasing power during inflationary periods. And once investors begin understanding these layers, yield strategy, compounding timelines, tax efficiency, inflation protection, and portfolio diversification, the passive income conversation conversation shifts from being about chasing income numbers to building income systems designed to last through economic uncertainty, market volatility, and long-term financial goals. Because the real question isn't just how to reach $1,000 per month, it's how to build passive income streams that continue working reliably while markets, interest rates, and economic conditions constantly evolve. And this is where most passive income plans either succeed or completely fall apart. Portfolio sustainability. Reaching $1,000 per month is one milestone, but maintaining that income for years or decades requires designing investments that can survive market downturns. Many investors build passive income portfolios during strong bull markets when dividend payments are stable, asset prices are rising, and economic growth supports corporate earnings. But during recessions or economic slowdowns, companies may reduce dividends, bond yields may fluctuate, and income-focused funds may adjust payouts. Investors who build passive income strategies without accounting for economic downturns often discover that income streams they believed were guaranteed suddenly become unstable. The most reliable passive income portfolios historically combine multiple income sources: dividend ETFs, bond income, real estate exposure, and growth assets, creating a layered income structure that reduces dependence on any single investment type. Another critical element of building $1,000 per month passive income is understanding timeline acceleration strategies. Most investors assume reaching passive income requires decades, but certain strategies can shorten the timeline without relying on extreme risk. Increasing monthly investment contributions, reinvesting all dividends, increasing income through career growth or side income streams, and strategically allocating bonuses or tax refunds into investments can dramatically accelerate passive income goals. U.S. market data consistently shows that investors who increase contribution amounts over time, instead of keeping them static, significantly improve long-term portfolio growth. Passive income is rarely built through a single decision. It is built through thousands of small, consistent financial decisions compounded over years. There is also an often overlooked factor that dramatically affects passive income planning: interest rate environments. When interest rates rise, bond yields and fixed income investments typically become more attractive, allowing investors to generate higher income with less capital. Conversely, when interest rates fall, income from bonds and savings instruments often decreases, pushing investors toward dividend stocks or alternative income investments. Understanding how interest rate cycles influence passive income strategies allows investors to adjust portfolios instead of relying on outdated income assumptions. Many successful income investors regularly review macroeconomic trends because passive income investing is deeply connected to Federal Reserve policies, inflation trends, and economic growth cycles. Another reality most investors don't consider is lifestyle cost flexibility. The goal of earning $1,000 per month in passive income can mean very different things depending on individual financial responsibilities. For some Americans, $1,000 per month may cover essential expenses like utilities, groceries, or insurance premiums. For others, it may represent supplemental retirement income or investment reinvestment capital. Investors who clearly define how passive income fits into their overall financial life tend to build stronger and more sustainable strategies. Passive income is not just about replacing earned income. It is about creating financial breathing room, reducing dependency on employment income, and building long-term financial resilience. There's also a mistake many investors make once they approach their passive income targets: stopping growth investing too early. Some investors shift entirely into income-focused investments once they begin generating monthly cash flow. While income stability is important, eliminating growth exposure can create long-term problems, especially when inflation increases or healthcare and living expenses rise later in life. Balanced passive income portfolios often maintain exposure to growth-oriented ETFs alongside income-producing investments, allowing portfolios to continue expanding even while generating consistent monthly payments. And then there's the behavioral advantage that separates passive income dreamers from passive income achievers. Consistency during market uncertainty. Market volatility often creates emotional pressure that causes investors to pause contributions, sell investments prematurely, or abandon long-term income strategies. Historical market performance repeatedly shows that investors who continued investing through recessions, bear markets, and economic crises often reached income milestones faster than investors who waited for perfect market conditions. Passive income is built during ordinary months, boring investment periods, and disciplined financial routines, not during dramatic market headlines or viral investment trends. Another strategic advantage involves automation. Many successful U.S. investors automate monthly ETF contributions, dividend reinvestments, and retirement account allocations. Automation removes emotional decision-making and transforms passive income building into a structured financial habit. Investors who automate investments historically demonstrate higher consistency and stronger long-term portfolio growth simply because they remove hesitation and market timing behavior from their strategy. And when you step back and look at the entire passive income equation, the numbers begin telling a clear and realistic story. Earning $1,000 per month in passive income typically requires somewhere between $150,000 and $400,000 invested, depending on yield strategy, risk tolerance, and income sustainability goals. But those numbers aren't meant to discourage investors. They are meant to provide clarity, because clarity transforms passive income from a vague financial dream into a measurable, achievable financial target. Once investors understand the numbers, they can build timelines, adjust contributions, and create structured plans instead of relying on unrealistic expectations or high-risk shortcuts. But here's the most powerful realization many investors experience once they begin this journey. Passive income is not just about the money showing up every month. It's about control. It's about creating financial flexibility that allows people to make career decisions without fear, reduce dependence on unpredictable income sources, support families with greater stability, and eventually build financial independence that compounds across generations. And the investors who successfully build passive income streams rarely rely on one lucky investment or one perfect financial decision. They rely on understanding the math, respecting the timeline, managing risk intelligently, and maintaining consistency even when results feel slow in the beginning, because passive income doesn't usually grow dramatically overnight. It grows quietly, steadily, and almost invisibly until one day the income your investments generate starts covering expenses, then covering lifestyles, and eventually building financial freedom. The question isn't whether earning $1,000 per month in passive income is possible. History, data, and market performance show that it absolutely is. The real question becomes whether investors are willing to commit to the discipline, patience, and strategy required to turn that financial milestone from a calculation into a reality.